Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're going
creators
mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Alt Goes Mainstream podcast. Today's episode takes us inside the world of technology with a deeply experienced expert in private markets tech. Griff Norville is a managing director and head of technology solutions at Hamilton Lane, the $865 billion AUM alternative asset manager. Griff leads the firm's tech-enabled analytics, forecasting, and investment diligence platform, Cobalt LPTM, and related portfolio reporting services, and co-heads the firm's technology committee. Griff focuses on building proprietary tools and strategically partnering or investing into private markets fintech companies as part of the firm's efforts to drive digital transformation within the industry. Griff also leverages his background on the investment side to help inform how he thinks about technology transformation within private markets. He previously co-led Hamilton Lane's research team, where he was responsible for leveraging data to assess private market trends and advise clients on investment and portfolio construction strategy. Griff and I had a fascinating conversation about the evolution of private markets technology and why it's an exciting time for innovation in the space. We discussed how private markets are moving from the Stone Age and Excel age to a digital age, why most GPs are still underinvested in technology, how Griff approaches the build, buy, invest question, why Cobalt was so foundational to Hamilton Lane's work in private markets, how technology innovation has driven product innovation when working in the wealth channel, and what comes next for technology in private markets. Thanks, Griff, for coming on the show to share your thoughts and wisdom on how technology is impacting private markets and for the work you're doing to invest in technology that's transforming the space.
We're going mainstream.
Griff, welcome to the Alt Goes Mainstream podcast.
Hey, Michael. Thrilled to be here.
Pleasure to have you on. You have such a fascinating perspective because you've been at Hamilton Lane for quite some time in a variety of tech-related roles, both on the investing side, but now also on the technology side, thinking about how to work with private markets from a technology perspective, investment perspectives. Would love to hear your background of how you got here and also maybe overlay that with the evolution in private markets that's happened around the same time.
I'll intro Hamilton Lane just for a little bit. For those not in the know, we're a global asset management firm dedicated purely to the private markets. And we've been in the business about 32 years. And I've been here 14 years of that. So I've had a nice run here at Hamilton Lane. And it's been a really exciting place to be. We were about 100 or so people when I joined, and now we're about 700. I've seen a ton of evolution in our business, a ton of evolution in the industry at large. And it's been about, I'd call it like 3 or 4 different sub-careers that I've had within the firm, which has been really cool. It's kept things fresh. I joined, it was a much smaller place back then. I was on the investment team. Everyone did all kinds of different investments, from fund investing to co-investing to secondaries. I underwrote deals. But the story of my career is always that someone figures out that I'm good with data and tech, and then they put me in a position to leverage that. And I used to fight back when I was much younger on that, wanting to be a deal person. That was the exciting place to be. Then I leaned into it. I realized that this is actually a super additive skill set, and I can be really differentiated in the way that I add value.
You make a really interesting observation about the importance of technology, both internally within an investment firm's operations, but also externally, whether it's investing in or using technology that's enabling private markets to grow. How do you think about that connection between the technology function and the work you do there with the investment function?
On the investment side, we want to use data to drive an advantage, both in investment selection, which is what everyone talks about in this industry. Let me find the best deal. Let me find the best manager to invest in. Of course, the industry being a fairly young one and no one really had data decades ago, was still very much investing based on relationship and gut instinct. But that has changed. You look at where the public markets are now, and every bit of alpha and advantage has been driven by tech these days. There's only smaller incremental returns to be made about greater investment in that in the public markets. In the private markets, there's still a ton of runway to get a ton of value out of that. And people have realized, oh, we can use data to make better investment selection decisions. And then you've got a side that is extremely underinvested in, and that would be thinking about portfolio construction. How do I build out a portfolio? How do I factor in my commitment planning tools to understand how much to put to work each year, which sub asset classes to fit my portfolio into? How do I manage my risk and return against my targets and my appetite for those things? And so over time at Hamilton Lane, we realized that we could use our position in the market and all of the information and data that we had to really drive an advantage in the way that we have conversations with our clients around decision making. Yes, on investment selection, and even more so, really on the portfolio construction piece, which is just not a conversation a lot of people were having, and we felt was just as additive to your overall return profile.
I think you're hitting on something that's so important and seems to be an increasingly important trend in private markets, which is conceptualizing where alts fit into an investor's portfolio. Maybe within alts, figuring out what the right strategies are and seeing everything, if you're an advisor, held away assets, et cetera, all in one place. B, also seeing alts within the construct of an entire portfolio. How have you thought about building such technology or leveraging the various solutions out there to accomplish what you want to accomplish, from creating the right portfolio construction that you can help drive investments and advice for clients?
My experience running these allocation models is you plug in, let's think about modern portfolio theory here. You plug in your assumed volatility and your returns, and then it tells you to put everything in private markets. Because over the course of history, we've seen using our data and the reliable data sources that we rely on, that private markets has outperformed in most years. Now, of course, what's not factored in there is liquidity appetite. And so that becomes a driving force in the conversation of how much illiquidity can you take. And then within the asset class, it used to just be private equity was buyout and venture, and now you've got strategies related to private credit, obviously, that's exploded in popularity, real assets, including real estate and infrastructure, and then the subdivisions within those just keep multiplying. Long dated credit, short maturity credit, two examples. And on the infrastructure side, different flavors of what that means, whether it's energy related or more structural infrastructure. And each one of these has very unique return profiles, risk profiles. And so when we think about what an investor needs in terms of their overall portfolio, the conversation can be very different between strategic investors, institutional investors that are, let's say, sovereign wealth fund that has a really long duration and is chasing return multiples across many, many years, versus clients that don't have the appetite for illiquidity and need to be able to get in and out of the asset class. And thankfully, there has been newer strategies developed that have those shorter durations and ability to get liquidity. And so often what would become this modern portfolio theory of allocation that kind of moves away and off to the side, and you're having more subtle conversations around appetites, around liquidity that drive portfolio construction.
You ended up actually buying and bringing in a technology solution to help with certain aspects of portfolio construction and other things as well. What was your decision process around deciding to do that? And how did you think that could both help you internally at Hamilton Lane as advisors and allocators, but also externally in terms of educating the market and also selling that technology solution?
So we were sitting around the table as an executive committee, I would say close to a decade ago. And at the time, things were different for us. We were much smaller. We didn't really have a great group of technologists at the firm. I would say that's changed. And huge shout out to the terrific group of technologists we have today. But we didn't really know what we were doing. We knew we had the data, but we thought we needed partners to help us capture more data, make sense of it, and get it out to the market. We knew our clients were hungry to get access to that data themselves. There's a story we have of how we got involved with this group called Bison. I was actually at a conference in California. I dropped my business card in a fishbowl and I won a free trial, quote unquote. Of course, I assume that everyone who put their business card in the fishbowl that day got the free trial. But I knew as soon as I logged into this application, this very young team had built, that this was a terrific interface that looked like something a consumer would want to use for how to analyze private markets data, but they didn't quite have all the data. And that's one thing we did have. And so instead of just calling up the salesperson and offering to subscribe to the software, what we did is we called them up and said, "Can you introduce us to your CEO?" And it just happened to be perfect timing. They were fundraising. We needed a partner. We, at that time, entered into a very strategic relationship by which they would do a lot of the building of the tech on their side, and we would manage all the distribution out to limited partners and the support of limited partners as they use the tool. And we would flow all of our intelligence, all of our data through there. And within a couple of years, it became obvious that it was extremely strategic to how we wanted to be interacting with our clients moving forward. And we made the decision to buy our partner out and bring all that in-house, bring that technology in-house. And that was the start of what's become a really big technology operation here, where now we build a lot of technology, but we don't build everything. We focus on tools that our clients want to use to interact with the digitized version of who Hamilton Lane is. As an investment solution provider, if a client wants access to our research, our benchmarks, our market analysis, that's what we build. We build it through an application we call Cobalt LP. That's what we provide to our clients today. And so we're building a technology business in-house. But for other things, we are more than happy to buy and partner. And we actually have an effort called HL Innovations internally. We've made over 18 balance sheet investments in other exciting technologies that are going to really improve us and the industry.
How do you think about that decision to build in-house or acquire and then have that in-house versus invest and partner?
If it's our secret sauce, we're going to lean to building it. I think that we have a bias that we think that we understand this industry extremely well when it comes to putting data to use for investment selection and portfolio construction. So in that respect, I think we are best positioned to build something that our clients are really going to connect with. It's also allowed us to take our traditional business and scale it. Those of you that know Hamilton Lane from 30 years ago, we started as more of a consultant and non-discretionary manager. Today, you would know us much better as a discretionary asset manager. But that side of our business that was non-discretionary in terms of advising on portfolios, reporting on portfolios, offering you benchmarking and forecasting, that's all been digitized. And what that allows us to do is take a group of clients that was 10, 20, 30 clients where we're offering very customized one-on-one services. We've digitized that product, and now we can offer that service at scale to clients of all different sizes. And so if we have something that we know our clients want that fits within the framework of advice, research, market analysis, we're going to look to build that typically. But for nearly anything else, and there's a whole lot of other problems to solve in this industry, we're going to look for the best available partner out there.
How often are clients coming to Hamilton Lane because of the technology solutions that you have?
I think it's a huge differentiator for the way that we interface with the market. Sadly, it's been told to me that a lot of us sound the same when we go out there fundraising. We all show our track record. We're all top quartile, of course, and we're all talking about our differentiated deal flow and our process. Hamilton Lane has all those things. But what really differentiates us is when we put forward our technology, our reliance on data, introduce that as a core part of our DNA, and then tell the client that they can have access to the same intelligence that we have internally, that they can follow in a transparent way the way that we do deals, the way that we work a deal through our workflow, the way that we benchmark, analyze. They can see all of it step by step through Cobalt. And that really brightens up a room when you're talking to a client that way, because our clients are hungry. They want to be great investors themselves. They're going to rely on us as a solutions provider and partner, but they would love to understand this industry at a deeper level the way that we do and go out and do their own deals. And we want to empower that. That's how you build a long-lasting relationship with someone that's bi-directional. And so we're happy to provide that tech.
What would you say are some of the missing pieces from a data perspective that maybe either you can't get right now, or if it was more automated, things changed a bit in the industry, you'd then be more efficient as a business, either pre-investment or post-investment?
We have all kinds of issues with data in this asset class still. One of the main issues, of course, is that very few people have access to a vast amount of data in this industry. You can count them on one hand, and even fewer know exactly what to do with it to make sense of it. But that's the huge problem for all of us, because as you talk about alts going mainstream, folks want to have confidence in investing in this asset class. They need to have transparency into what they own when they're investing in the private markets, down to the deal level, the metrics of those companies. If they're interested in ESG, they're going to want to understand data around that. What we're doing on the back end is still passing information back and forth over PDF. And that's incredibly difficult to translate into transparency and data to flow down to the end investor. So I'm working with a lot of companies to help solve that, both pre and post investment. So the pre investment side, there's going to be a tremendous company by the time this airs, Daphne, that we've helped to fund, will be out there presenting their solution on a pre-investment side to replace the old static data room or deal room that people might use to understand a GP's offering, to replace that with a digital representation of that manager's track record, terms, fundraising calendar, you name it, the type of information where it would be good to immediately get updates on that information if it changed, not receive it over email. Who might need that updated at mass scale? Well, any of the marketplaces that are being built to offer direct access to this asset class to private wealth type investors. I mean, this is a problem of scale now. We can no longer be communicating over email. So GPs can permission that data out pre-investment using Daphne. And Daphne can be the utility that powers the industry to have a digital data offering for anything that's out there fundraising, and automatic updates if terms were to change or a fundraising calendar were to change as track records were being updated. That's really exciting. And on the post-investment side, for example, working with another company called Canoe. And what Canoe does is on the monitoring side, this is after you've made the investment. There's a lot of documentation being passed and forth between GP and LP, fund financials, partner capital statements, cash flow notices. Canoe offers a platform to aggregate, organize, and extract data off of this unstructured data type. So again, it would be great if we had some standardization and structure with all this information being passed. And if we get there, I know these companies that I'm talking about will be on the leading edge of helping provide the standardization. But in the meantime, operating the world we currently live in, this data is still passed over PDF, but maybe human eyeballs no longer need to read that PDF. And these technologies like Canoe can extract that data, pass it downstream to your systems that you want to use to analyze it.
What's the origination process of figuring out how to best solve some of these problems that you mentioned? You know, obviously, Daphne, it sounds like you met in process. They're incubated by Motive and Apollo. Canoe, you obviously invested in relatively early on. What is your process internally of saying, okay, here's a problem we need to solve. How do we go about and solve it? And maybe how do others in the industry also come about and solve it with us?
Often we're thinking of the problem. We're living in a world in which we have over $850 billion in assets under management. We experience the problems firsthand that exist in this industry. So if someone comes with us with a very bright idea on how to help this industry, we're typically feeling the pain somewhere internally, and I can tap an expert internally in an organization that's closest to the problem. We often are out there just looking for potential solutions, meeting with entrepreneurs, expressing to them what our challenges are. The process today has become easier because we've made some of these investments that you're talking about. Years ago, our first investments were the iLevels and the Deal Clouds of the world. And these groups have done very well. They've transformed the way this industry operates. And we're in a fortunate position now where a lot of people reach out to us. They value our history in the asset class, our expertise, our experience, and that helps advise them on how to break through, how to grow. Of course, we've got the Rolodex there that can help. So they're searching for us to provide that expertise, and we are more than happy to do that if we have a voice at the table and a way to influence them to build something that's best built for purpose for our clients or for us. So usually it's mutually beneficial to get together.
You've been in this industry for a long time, both as a firm, and then you've seen the evolution of technology solutions itself as you've watched things unfold in private markets. It's interesting to hear you talk about the importance and influence of strategic investors in this space. And a lot of what you're talking about too are problems that the whole industry is facing, call them industry utilities, right? As companies that are being built that have a lot of strategic participants. Do you think that private markets are unique to fintech more broadly, where because there are a set of large players, the publicly traded alternative asset managers like yourselves, does that make this different in terms of how the best companies will be built than other areas of fintech or tech more broadly?
We're still a small industry where a lot of people know each other, and that sometimes helps, sometimes hurts. I mean, it's hard to get 8 strong personalities from representing these 8 firms to get together at a table and all agree on one thing. That's a problem of itself. But when you really want to set your mind to it and change the way this industry operates, there's not too many people you need to call. That's the flip side of it. I've seen some repeat entrepreneurs and some repeat funders here, repeat investors and VCs that are solving one problem after another. They get a really deep understanding of the issues here, and that helps move innovation through a little quicker. For me, that's been helpful over the last 10 years to kind of get the gang back together over and over and knock one thing out after another.
How do you balance that desire to create standardization versus making sure you're maintaining your competitive edge and building proprietary technology in-house, as well as kind of keeping sanctity amongst those proprietary investment processes?
That is tough. We do strike a balance. One example would be our internal tech that we build, Cobalt. That's just for us and our clients. We are not likely to give that out to any of our competitors. This is a competitive asset class. We're all out there fundraising, and this is a tool that we're going to leverage, and we're more than happy to have strategic partners and clients use it, but it is proprietary to us. But there are many circumstances, the Daphnes and Canoes of the world, where this is a rising tide lifts all ships situation. If we can solve that big question of access and get more participants in this asset class through greater transparency of data, greater operational efficiency in how subscriptions move through the system, how secondary transactions work, these marketplaces, all of that will tremendously, yes, it will help out everybody, including us. And we're more than happy to support a number of different groups chasing that same dream.
I think you bring up an interesting point, which is how can technology create efficiencies, particularly post-investment, which in theory should reduce costs, which should also increase margins. Now, where my mind goes with that is if you can successfully reduce costs with technology, particularly on the administrative processes for investors and increasingly the wealth channel, do you think that that makes it easier to think about lowering fees?
I think that we're looking to today eliminate friction for access to this asset class, and high minimums would be an area that I would really focus on. I know that we spoke about tokenization earlier, and I would bring that up at this point. We're still very much in early innings, and when I talk about tokenization, I would separate it from cryptocurrency and anything FTX related, of course, but this is not speculation. What this is searching for a better way operationally to sign people up into the asset class, manage what they own, potentially provide for fractionalization of shares moving forward, and eliminate the types of operational inefficiencies that lead us to require such high minimums to access the asset class, that lead us to have such high expenses on our side to manage this asset class. So that's one example of if we were to get the flywheel running on that, and get the volumes that we need to develop a market around these tokens, I think a lot of people would benefit along the way and make this, a cheaper asset class down the line.
What are the challenges with increased adoption of tokenization?
Education is a big one, regulation, of course. When we talk about working with groups that are focused on blockchain technology and tokenization, there's a couple coming to mind right now around Securitize and Addix. Securitize operating in the US, Addix out of Singapore. What we're looking to do is work with the people that understand the regulations very well, are working hand in hand with the regulators. Singapore, I'll bring up as an example. These regulators want to be the leaders in regulating this. So we're talking about highly regulated, trusted parties that we want to be working with. And it's about educating the rest of the market on the advantages here. and how this is safe. Of course, certainly something like FTX probably set us back a good bit. Today, it's still conversation after conversation of education. And of course, the technology continues to improve. And I think that 2024, 2025 could be a year of explosion in the use of these tokens. But today we're still early because people are still getting to know it.
Yeah, it'll be interesting to see what it takes for tokenization to move forward. The fact that large firms like yourself, KKR, also has a tokenized fund, you can start to see some of the hints of it coming, but it's still obviously very early in that process of what's it going to take to make that happen. And I do think the custody piece of it is where are people custodying their tokens? That obviously you wouldn't do that yourself, but the challenge of that, I wonder if that's a hard part about people wrapping their head around it. If you think about private markets, you mentioned Hamilton Lane's been around, I think it was 32 years. You've been there for almost half of that time. You've obviously seen this arc of technology occur at both Hamilton Lane and private markets more broadly. How far do you think technology's really come in terms of it being applied to private markets?
Obviously, we are super invested in the use of data and tech. It's a big part of what we talk about as we approach the market. But I think the honest truth is that there are many participants in this asset class that are falling behind, that are still stuck in Excel, which is obviously a flexible tool. And I read the same humorous articles. You're going to take Excel out of my cold dead hands kind of thing. But that doesn't operate at scale. And for us, we've been able to leverage data fabric, data controls, and built for purpose analytics systems to really power our teams. I think that we're operating at a bit of a different scale than a lot of groups, but now I'm seeing it down at the small 3-person family office investment team. They're hungry for data and tools to make their lives easier. They realize that they can't balance these PDF financials and these Excel-based models they have. I do think there's going to be a separation of winners and losers in this asset class. The GPs and the LPs that refuse to focus on investing in themselves, spending that marginal dollar on their infrastructure and the build out of their tech, they're going to fall behind. They're not going to be finding the best investment opportunities and taking advantage of the types of portfolio construction decisions we were mentioning earlier to optimize their portfolio.
What advice would you give to firms who are maybe a bit behind in leveraging technology as to how they should go about doing it if they were just thinking about starting?
I think one of the mistakes I see people make is that they're looking for something that will solve every single problem. So I see a requirements list of what they're looking for, and it's pages long, and it touches everything from pre-investment to post-investment to AI to blockchain to whatever, right? And they want to see what they can get. And that's not our experience. There's not one system to rule them all kind of thing. It's about finding the systems that fit your process the best and then focusing internally on flowing the data between them, linking them. A lot of these systems today, they've got open APIs. You can connect them. You can flow the data from one to the other. You have to internally be careful about your data controls, and you don't want garbage in, you'll get garbage out. But you're going to have to piece together probably a few things to accomplish what you want. And maybe the teams that operate your back office are using different tools than the teams that are operating, your front office and your analytics. In that case, I would look for best of breed type solutions.
Smaller firms or larger firms benefit more from all these technological advancements in private markets?
I think the smaller firms are able to take huge advantage of all the investments made and the pressure that the larger firms have put on companies and entrepreneurs to solve these challenges. Now, I think the smaller firms can take advantage of tools that have become much cheaper to buy and use. It's led to an explosion, I think, of participation, and smaller groups can now think and act in the same way that their larger peers are. It's allowing smaller groups to punch above their weight. So in many ways, you could say the smaller groups have taken better advantage.
How do you think that's then going to play out as it comes to asset management space? And kind of where I'm going with this is we've obviously seen a lot of consolidation recently, both between alternative asset managers trying to supplement the strategies they have, as well as traditional asset managers acquiring capabilities, BlackRock acquiring GIP is one large example. But how do you think all of that and the technology innovation and what firms can use feeds into the way in which firms themselves will evolve?
It's still really about who has the data at the end of the day. So if you've got all this great tech, then you need to get the data from someplace. So there's still an advantage at scale. The flip side of what I was just saying, to having access to data you can reliably collect, organize, and make use of, or that you're going to license from somebody. And some people are going to be pretty protective. So you see this consolidation happening in the industry. Obviously, there's a consolidation of assets and relationships, which is a big driving force. You can't overlook the consolidation of access to information and the ability to use that data to understand where to go next.
It's fascinating because as you talk about data and the advantage that a firm like Hamilton Lane has, 850 billion of assets under management and advisement, and being able to see all of the data that you have residing underneath that, how much do you think of Hamilton Lane as a data company rather than an investment company?
We're still an investment company first and foremost, but of course, if you're going to ask my team, they see the what's behind the scenes and how much data is powering what we do. I guess you look at any successful business in this world, from McDonald's to Tesla to Hamilton Lane. Aren't we all tech enabled these days? And so is Hamilton Lane a tech company? Well, I mean, you can kind of laugh about it and say, obviously, we're putting a ton into tech, and some of the ways that people interact with us is only through tech. So some people might have that lens on us. But in many ways, what we have done is we've created a tremendously tech enabled investment business that's allowing us to be differentiated and drive huge advantages in what we do over our peer set.
Where do you wish in the past or going forward you spent more money and resources on tech?
You can never invest too much in the data collection and control space. It's probably the space that's most often overlooked because it's easy to fall in love with impressive looking dashboards and fancy looking forecasting tools and benchmarking. And I love that stuff too. We build it and it helps. But then you start realizing, where's this data coming from? And can we trust it? Too many people overlook that investment on the back end. And that's a huge place that we're focused now. Of course, with AI, that's other tools that are even hungrier for high quality data. You see what happens with those tools when we have low quality inputs. So there's going to be a whole lot of reckoning in this industry with people realizing, oh, we never really invested enough on the back end, getting our house in order, so to speak.
So you talk about investing. I want to move to the investments that you've made. You've invested in, I think it's 18 companies. Correct me if I'm wrong on that, but it's something of that magnitude across the life cycle of an investment in private markets, from pre all the way to post investment. I'd love to hear a little bit more about the investments you've made and why you've decided to make each of those investments, because you have such an interesting perch and perspective on private markets from where you sit. So I imagine those decisions to invest were informed by plenty of experience and data with what could be done differently.
You're right. We've done 18 investments off of our balance sheet. So we call this our HL Innovations effort. Typically, what we're doing is we're investing. I wouldn't say it's typical in the seed stage. That has happened. Typically, it's Series A and B. There's some product there. There's revenue. We get to look at something, touch it, use it internally, see the value that it can deliver, and then we're going to help take the company to the next level. A company needs to be in favor of us having a voice at the table. They want to look for our experience to add value to the board meeting, or sometimes we'll just be an observer. And that's often a key part of it. We're not trying to overly control anything. What we're trying to do is make sure that we can bring what we know to be the problem set in the industry and the way that we've thought about solving those problems. We can bring that to the table and help these entrepreneurs and young teams really solve problems. So yeah, there's been 18 examples of this, and I would say they cut across three big buckets. You've got the data and analytics side, accessing proprietary, unique data sets, integrating them into the data fabric that we have and making sense of that data through analysis. You've got the second bucket, which is operational excellence, the way that you subscribe to this asset class. For anyone out there that hasn't yet subscribed to a private market fund, you might be hit with 100 pages of documentation to go through. it's actually a fairly painful process that a lot of groups are very interested in making a whole lot easier. The way that you internally extract data from these unstructured document types, we've talked about that already with Canoe. So we're going to focus on operational excellence. The third bucket would be access points to this asset class. We talk about tokenization efforts with Securitize and ADDX. We talk about groups like iCapital and Case. These are groups that offering marketplaces for newer investors, smaller investors, high net worth folks to understand what is available in the asset class, to educate themselves about the asset class. That, to us, is another key bucket as we focus on introducing this asset class to a brand new segment of the market.
What's your goal when making these investments? Is success, this helps Hamilton Lane do its job better? Is it creates an industry utility? Is it financial returns?
Financial returns are helpful, but they're not the driving force necessarily. We're looking for tools that will help us be more efficient in the way that we manage our business, and then we'll help our clients. And for us, giving back to the ecosystem of the private markets and helping the industry at large, I think that just has provided us a lot of tailwinds to grow and do what we want to do in the industry. It's also helpful for our brand. I think we want to be recognized as leaders in innovation, in the use of data. And to do that, we need to be out there in the weeds, making this industry a better place. That brand helps us with the way that we interact with clients, the way that we fundraise and get to know new people.
If you could request for something to be built in private markets that hasn't yet been built, that you wouldn't build yourself internally, what are some of the missing pieces from a technology perspective that you'd love to see get built?
The talk of the town right now is AI, and that can mean a lot of things to a lot of people. But today, we've got a lot of processes internally that are very manual and involve things like summarization. And I think that AI can be tremendously helpful. I'll give you a few examples that we're starting to roll out and that we're asking companies to help us with. There's one investment we've made in company that we've started with Tiffin, another group called Tiffin, called Helix by HL, that we're introducing to the market around this as well. I can talk about that. But I think that what we're hoping to do is all these meetings that we're having with GPs as we monitor our investments, as we get updates. Of course, traditionally, we've had a lot of people typing notes and putting that into the CRM, and how do those notes get used? They're available, but now you've just got this broad swath of notes, and how do you deliver insight from that? We're finding that these AI tools are becoming very effective at listening in on the meeting, forming summaries, alerting other groups when certain pieces of intelligence are surfaced in those conversations around, let's call it co-investment opportunities or secondary transactions as one example. So we are able to take intelligence collected by one team at this large firm and quickly disperse it out to other teams that might need that intelligence. We're still early in experimenting with this tech, but it's very promising, and we're pushing forward on these entrepreneurs to continue building. Another example would be processing new investment opportunities. Of course, what typically happens is you're getting a private placement memo, a deck, a presentation from a GP or a company. How do you quickly summarize that into a screening? And that's typically been a rite of passage for any analyst, that you're pumping out 200 of these screenings a year, whatever it is. I think that analysts in the future can spend more time on second level investment thinking, because the AI tools today are getting so much better about processing, summarizing, and presenting that initial level summarization of the investment opportunity. That's another place we're pushing.
How much do you think AI is really going to impact private markets in the short term?
In the short term, I'm most excited about education, helping financial advisors that are representing the wealth world get smart on this asset class, sound smart to their end clients. The AI is pretty good at that. What we've done is we've built this tool called Helix by HL that can leverage. We've got 30 years worth of history here at Hamilton Lane, a tremendous set of white papers and research that have been written by our very smart portfolio allocators. The AI bot now can answer questions in their voice based on the information that we've seeded it with. That's something that we have available right now. And forming a recommendation to a client using intelligence gathered from Hamilton Lane over the course of 30 years is becoming a whole lot easier to do that quickly get up to speed on the asset class and make recommendations based on that intelligence using the AI.
Do you think advisors need to understand it themselves before employing AI? Or can they really leverage this to just be more efficient in their time? Because this is one part of their business. They have to do a whole host of other things as well.
Absolutely. I think that this is the type of tool that lives within other tools they're using day in and day out. I know that as I think about AI more, as I talk to more people in the industry, is the chat-based interface going to be the end solution for everyone? I mean, there are certain use cases for that, but maybe not as sort of this independent tool that you'll go to just to answer your private market questions. But if we can bake this functionality into the other everyday tools that these advisors use, so they don't feel like they're flowing out of their everyday dashboard for their other activities, I think that's really our goal with something like Helix, to fit it in to those other technologies, and it'll seem seamless. Whether or not they know they're interacting with the AI, depending on what we're doing, they might not have to even know. But we've created content that will help them through that.
You're hitting on part of the market that is so increasingly important in private markets, which is the wealth channel. How do you think about technology serving the wealth channel, and why is that so important to push private markets forward into the next phase?
Technology has to reduce the frictions. If you are a high net worth individual, what might you be afraid of here? Obviously, liquidity. We've talked about tokenization. Obviously, these open-ended investment vehicles, that's more innovation in terms of structure. That's helping. But there are other technology innovations that we can do to help streamline the ability to gain liquidity once you've invested in this asset class. So they're worried about liquidity. They're worried about transparency. They want to know how what they've invested in is doing, how it's benchmarking. They want to trust the data sources. It's quite easy to do in the public markets these days. There's established ways to benchmark against the S&P 500 or Russell 3000. And in the private markets, what's the comparable there? And I think we're racing towards having data sets that are more widely used and trusted, and Hamilton Lane is trying to play a big role in that. The other thing they're worried about is, where's the marketplace where they can access? I think that there are more and more of these solutions being built to offer these wealth managers and the clients they represent to gain trust that, okay, I'm not just seeing funds from the top 5 big names that everyone knows. I'm seeing the rest of the universe too, and I can make my decision comparing all that together.
So that's an interesting question, because on one hand, yes, giving investors, whether advisors or self-directed individual investors, more agency over what investments they make, that could be a good thing in some ways. But I think you may have your own views on this at Hamilton Lane, and I suspect we'll agree. I think most investors should actually be investing in private markets, particularly in categories like venture, actually through things like fund of funds, because there's professionals every day doing this. Now, you have touched on something which could be related to the point about investors making their own decisions, which is if you can leverage data. Do you think that we'll end up in a world where investors have more choice and agency over what they invest in, because they will be equipped with the data to be able to adjudicate which funds they should invest into, but advisors have to be able to see enough to know what's good and what's not?
So where's that balance? But you're right. At some point, the deluge of options becomes a hindrance. Then you're confused about, there's 1,000 opportunities that Hamilton Lane sees every year, actually 1,200 to be more specific, in terms of just fund investments. That doesn't count co-investments and secondaries, which probably triples that number. How do you, as a newer investor to the asset class, make sense of all that? There are some groups, let's call them family offices, that are pretty sophisticated. They're going to want to see the 1,200 that are available, and they're going to want to filter that down and prioritize the right fit for their portfolio, and they're going to need tools to do that. There's going to be the smaller investors where maybe it's nice to know that you've got the availability to see that sea of choice, but they're going to need help with building portfolios, gaining the diversity they need. I don't recommend investing in 1 or 2 venture funds, for instance. I think there is the need for something like that, to have diversity, to make sure that you're capturing the risk and return profile that would be appropriate for an investor of your size. Groups like Hamilton Lane, we've had a lot of experience with that. and the ability to educate on portfolio construction and provide product that helps with those diversification goals.
Portfolio construction, that feels like such a massive unlock to enabling more capital flowing into private markets, particularly from the wealth channel. What do you think can be done in the industry broadly and maybe with certain companies as well to create ways for advisors and end clients to be able to see where private markets strategies fit into an entire portfolio?
We need to get the data more to an apples to apples comparison with the rest of their portfolio. So increasing the transparency down to the company level to understand what sectors these companies are in, what geographies they represent, what currencies you might be exposed to. That's something we've worked very hard at over the last, let's call it 5+ years, which has been a tremendous undertaking because this is not data that freely flows between GP and LP. You often have to go and search it out and put pressure on the GP to get that. So we're mapping the universe of private companies and the cross ownership between GPs too. All of that is going to be needed for end investors to really understand the inherent risks in their profile beyond just the fund name, which doesn't give you a whole lot of detail around what you really own.
What you're saying sounds like we need the equivalent, if it hasn't already been built, of the Aladdin for private markets.
I think that's part of the goal. Obviously, Aladdin and BlackRock have had tremendous success with building that comprehensive solution. And the private markets are searching for tools like that. That's honestly a big part of what we've been doing internally with Cobalt is trying to fit all of that together so that you have a end-to-end robust analysis of what you own and what you should do to take the next step in building out your portfolio.
Taking the next step, what do you think private markets needs to do to get to the next phase? And what do the next 3 to 5 years look like in private markets?
I think the next 3 to 5 years could come with tremendous growth. I think that groups need to continue to, as I've said, invest in their technology stack internally to be prepared as these new product structures and new product types come out, which will offer a ton of opportunity for people to access this asset class in new ways, but also a whole lot of new types of analysis and ways of thinking about benchmarking. How do you compare an open-ended fund to a closed-ended fund, for instance? How do you think about the deals within those two funds and what's appropriate? These are questions that the industry is still actually just starting to tackle. There's going to be a whole new wave of types of benchmarking and analysis around these open-ended vehicles, for instance, around portfolio construction with the wealth client in mind versus the institutional client, because of course, those two groups think about portfolio construction very differently. And so this is still a place to me. I've talked about being at hamiltonlane for 14 years and the way that we've grown and the way this asset class has grown, but I'm just as excited for the next decade because we're entering some really new territory in terms of structure and investment types and new client types, which are going to have a whole new set of problems to solve.
Whole new set of problems, but also a whole new set of opportunities too. It really does feel like the large firms can also handle increased capacity in terms of size and scale of AUM growth. You look at the data, right? We're at 12-ish, maybe 13 trillion of AUM in private markets by end of 23. Preqin, I think, projected 17 by the end of 27. Goldman projected in the 30s by 2030 or so. Who knows if that number will be realized? But even still, talk about double the growth of private markets in the next 5+ years. It feels like there's a lot of capacity to be handled.
Absolutely. You look at the percentage of the MSCI world market cap that private markets represents, it's between 2 and 3%. A lot of people continue to talk about the growth, including me, and they look at numbers like the dry powder number or the deal flow, and they wonder if we reached some kind of limit. But I think we're barely scratching the surface here. This asset class has a ton of room to grow. It's what's being demanded. The return profile has been there. People are happy with the investments they've made, and they're asking for more.
It's incredibly exciting time in alts. I want to wrap this podcast with a question that I ask every guest, which is a little bit more personal, which is, it's an exciting time in alts, but for you, I want to hear what investment in alternatives excites you most.
I'm most excited about this Helix by HL investment we've done, this use of AI. Look, I think there's still a lot of unknowns with AI AI. We're learning more and more every day. But the fact that right after this podcast taping, I'm going to open up a bot and interact with it and get answers out of it that I never would have dreamed of even 6 months ago. It's been a really cool experience. It's something that I'm most looking forward to growing.
Maybe we'll have to do a second podcast where we both just use the bot to ask questions about alts and we can see how it goes.
We can dream. Yeah, I'm all for it.
I love it. Well, congrats on everything you've done at Hamilton Lane. Incredibly impressive. The firm you've built, the technology business you've built, and what you've invested in. So pleasure to have you on the show, Griff, and talk about alts.
Great. Thank you, Michael. Really fun to be here.
Likewise. Thanks for coming on. Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.